What's going on, Simos? How you doing, brother?
Good morning, REC Nation. From coast to coast, right here from the city of Toronto, Don Mills to be exact.
Coast to coast. You know who used to say that?
Good morning. It is a heavenly day. I started the day with a delicious breakfast.
Well, hang on.
Okay,
You mentioned breakfast. We have brunch with
I
us
only had
here.
a half a grilled cheese.
That was
but it was delicious. And a fruit smoothie this morning at home with further.
so. We're not going to eat our eggs Benedict and all that stuff that we have when we bring on our guest today. Maybe I'll hop over and grab our brunch catered by none other than Jordan. Make sure you go check out his profiles. The team here, Steven and Tyler, will make sure that they throw in the profile for Instagram and for Facebook. But as always, let us know where you guys are signing in from. I was speaking to Natalie Sang and Mike a couple of days ago. You know what they told me?
What?
They said every other Saturday at 10:30 a.m. they are glued to their TV because they stream the show on their TV.
My kids are doing that too.
Okay. And what's up, Gabriel? What's up, Sophia? They make sure that it doesn't matter if someone comes over, you're sitting there and watching Brunch with REC.
100%.
So big shout out to Mike and to Nat. We love you guys. And to everyone else, welcome once again to Brunch with REC. Make sure you let us know in the comments where you're signing in from. Also, let us know what you're having for brunch. Do you guys, have you already eaten breakfast? Like my boy Simos, and most likely our guest as well, he's eaten. Are you more like me, maybe hold off and try to break the fast later on in the day? Let us know what you're having, if you're actually having something. And a couple of quick housekeeping notes. One, the main reason that we switched to this platform to go live on Facebook is so you as REC insiders, you who is part of this REC family, can start to network with each other. Facebook's platform is very easy to do that. You click on someone's name in the comments here, shoot them a direct message. Look, we talk a lot about investing in real estate, and one of the quickest ways to get into investing into real estate is by doing joint ventures. How do you do joint ventures? Well, you could do it with family, friends, but you can also do it with people that are already in the community of investing, and you do that by networking. So start communicating and talking with each other. And then for us, our ask of you today is if you can click the share button. That's another main reason why we switched over to this platform, which is Facebook, is so you can share it with your friends, your colleagues, your neighbors, your family. And it's very, very easy to do on this platform. But today we're going to be talking all things stats. So we get our stats from the Toronto Real Estate Board in and around the 3rd, 4th, 5th of every single month. And that's how we dive in to what's actually happening, not only from a macro level in the greater Toronto area, which is important, and it gives us kind of a snapshot of what's happening. But if you're looking at a property or you're thinking about investing in downtown Toronto, who really, really cares what's going on in Hamilton? Like, it just doesn't matter to you as much. Again, not a bad idea to kind of just get a rough idea of what's happening. But when you're actually looking into a specific area, you need to do the micro analysis of that specific market. And so, I mean, the guy that we're going to be bringing on today, I mean, he's a returning guest. He's a very good friend of ours.
Our partner for 15 years.
For 15 years, go.
He is the owner of Royal LePage Signature, the owner of Broker. It's Christopher Slidham. Him and his family have been. They literally built. They're part of the fabric of the Don Mills community, Canada's first master plan community.
Not Canada's first master plan community, brother. North America's
absolutely first master plan community. And we were sharing stories a few nights ago. We got together, had a nice little barbecue, and so many cool stories came out of that night. More importantly, I wanted to mention, because now we're kind of starting to see, when we started REC Brunch in January, we were gonna have a plan as to who's featured, how, and the kind of value that we're bringing. But it certainly has turned out where the massive request, the biggest request of all, above and beyond specific topics, is the ongoing need for the interpretation of stats. Meaning anybody can go and get the stats. The stats are published for everyone. whether it's the second, third of the month, they're published. But what do you do with those numbers? How do you interpret them, and how do you put them to work for your specific mandate? That's what it's all about, and that's where I think to have Chris join us today. Chris leads an army of real estate brokers.
How many, to be exact?
Literally
buddy?
1,300 agents across the GTA, based out of Mississauga, Toronto downtown, and Don Mills to the east. 1,300 agents. That is, if anybody can imagine 1,300 people all out there to do one thing: dominate and provide value in the real estate business. And this is the guy who's leading them into battle every day. It's a guy who we turn to for advice. It's a guy who we turn to get his second on every decision that we make. This is what we're doing. What's your thoughts? Why? Because he's a visionary. And why? Because he has a very good and amazing record of his entire third generation real estate, where him and his family have been analyzing and looking at this thing for a long time. Anyways, tons of huge respect, tons of respect for Chris.
And I just saw Nat saying, sign in. Nat, not sure if you're here at the start, is giving you and Mikey a big shout out. A big congratulations to everyone also who from last brunch spoke to our representative in Florida, Orlando, Florida, to be specific, about the turnkey investment that Dawood, aka David, was talking about on our last brunch. Congratulations to all the insiders. I think we had a little over 15, 16 insiders who already have reserved a unit. So congratulations to you. If you weren't on our last brunch 2 weeks ago, send an email to info@reccanada.com, info@reccanada.com, with the subject line Florida, so we can make sure that we get that information over to you. I just saw my boy here, Tyler Ty Walburn. He's in the comments. Make sure, if you guys can tell, I'm not sure if you can tell, I'm watching my phone here because I'm in the Facebook Live with you guys. I'm monitoring the comments as well. Throw all your questions, any questions that you have in and around real estate, so we can make sure that we can do our best to answer them. Steven, I know you're going to start bringing in our boy Christopher here. Let's bring in Chris and let's talk about what we've seen happen in the GTA real estate market, as well as going very, very deep into the micro markets in this last month. I mean, these stats are like hot off the presses. They just came through to our inbox yesterday. I'll let you know how you guys can get a copy of the stats. The team's just working on the back end to make sure that we can get that over to you quickly. Steven gave me the thumbs up. So if you text stats, text the word stats to 647-372-0126. Text the word stats to 647-372-0126. Everything that myself, Simos, and Chris are going to be speaking about today, you can have your PDF copy of that. And for some reason, if it doesn't work, always just quickly shoot an email over to info@reccanada.com. Chris, how you doing today, brother?
Fantastic. How you doing?
Let's see how long you can keep that hat on while it being 30 degrees outside.
I just put it on. I have it here from the swag that you share with me all the time. Your great stuff you put together. I'm like, oh, this is perfect. It's going on. I've been had it on for 3 or 4 minutes. I'm absolutely sweating already. But I had to do it. I have to represent the team here. You guys are you never leave us out. That's for sure. You're doing an amazing job. So there you go.
Chris,
Love it. Thank you.
Give the
Gotta come prepared.
Nation a quick good morning, my man. We got people logging in from Burlington, Winnipeg, Greece, all over the place. Hamilton. Give your quick good morning to the entire REC Nation, my man.
Good morning, everybody. Great to see you. Thanks so much for having me join in today. You guys are done just an incredible job, and it's the information. And I was listening into your opening there. You've kind of set the bar high for me, but appreciate your kind words. But you guys have really done an incredible job at educating, and that's what I admire so much about the approach that you've taken to help so many people with real estate. It's such a great opportunity. We're passionate about it, obviously, And so, you know, we love it so much. And what I really love is the fact that you guys have taken the time. You do this so regularly to share, to educate, and just help people make great decisions about their real estate needs. So congrats to all of you, and good morning to everybody in the REC Nation. And is it okay if I take my toque off now?
Yeah, buddy. But we got Dani, listen, we took pictures already. We have the pictures for the gram, as the kids call it. So we're good. We're good. And thank you for that. Just mentioning how much we try to educate our community. I think we came up with a term which is removing the friction for our clients. I mean, we're not that good at selling stuff. And so what we decided to do is just make it easy as we possibly could for people to do business with us. And we found the best way to do that is to educate them. I mean, shameless plug, we wrote a book on it, right? Like we wrote a book on how to buy, how to sell, how to invest on your own. If you're new to the REC family and to the REC Nation and you don't have a copy for this, I got some great news. We don't sell it. It's free. It doesn't cost you anything to get it.
It's literally our manual on real estate.
And for you to actually buy, sell on your own, right? Sure. I mean, we'll peel back the curtains, guys. We know that in the nation of Canada, 98% of people use the services of a realtor. So we said, why don't we try to become the authority and educate you guys up front? And then if you want to use our services, we are here. We obviously are a full service real estate company helping anyone with their first property, their second property, smart sizing, as we like to call it, moving up into a bigger home, moving into a smaller home. And then obviously myself, I handle all things residential investments. And then my partner here, Simos, handles everything along the lines of commercial investing. Something that I actually want to bring up a little later on in our conversation today is kind of the whole commercial landscape, because we obviously are going to be spending majority of our time speaking about residential today. But I'm getting a lot of questions lately about the commercial space and what's going to happen, retail, all of that stuff.
And the good news to that is I spent last night probably between when Caroline was putting the kids up between, I don't know, 8:30 and 10 o'clock reading some articles on both The Economist, and there's a beautiful prop moto. It's a commercial real estate publication out of the States, but it's very, very savvy. It goes deep into you know how to look at things, etc. And it's talking about the return of the office, the survival of flex working. What does that mean for projections to commercial landlords in major urban centers? And I would love to touch on that because I have the data right at the top of my mind because I read last night. So I would love to share some of that insight for people to really understand what's going down on that side of the fence, because it's significant. It matters.
So before we actually even dive into all the stats that just came out, Chris, I know Simos gave you an amazing intro, but I would love for you to just kind of touch on like your family's history in real estate. Like, how did this all start for the Slidham family? Like, I know you guys, like, you obviously run an organization yourself and your brother now of 1,300, as Simos mentioned, but like that's not how it all started. I mean, you started by investing into real estate, like right back to your grandfather and building real estate. Can you just touch on that a little bit as we get people to sign on?
For sure. Yeah, absolutely. Happy to. We've been, that's all we've known in our time here in Canada. My great grandfather was a bricklayer, and that's how he came here and started as a tradesperson. And then they started building their own houses one at a time. And then from there, they built a few more, and that started to grow. And along the way, they built some investment properties as well that they kept for themselves that our family still has today, because we believe in the long-term value of investing in real estate over time. And then in 1965, they had an opportunity to acquire a very small real estate brokerage in Don Mills, where they had built the very first homes for the original developer of Don Mills, E.P. Taylor, and it was a natural evolution. And so they bought a little brokerage in about I think it was about 8 or 12 people at the time, and we've grown steadily over the past 5 decades into our 6th decade now in the brokerage business and investing in real estate all the way along.
6 decades, 60 years of
Amazing.
real estate experience. It's amazing. I mean, we've been doing this for 16 years and I'm like, wow, it's been a long time. And so that's why we wanted to have you come on and talk about obviously all things stats. So let's just jump into that. Like, stats just came out.
Yes.
Obviously, it's for the May real estate stats. Why don't we touch on kind of high level the GTA, and then we'll work our way into the micro stats. And we always talk about the most important market indicators, starting off with months of inventory. As everyone knows, that always determines if we're in a seller's market, balance market, or buyer's market. That's important to know because you can then start to try to figure out when you should be getting in the market. Macro thesis in investing in real estate, though, is don't try to time the market. Just get in and spend time in the market, because over time you will start to see, as Chris is going to show us today, what happens to values over time. And so, did you want us to bring up any type of screens or any, like, share a screen or anything?
Before we do that, I'm just going to show you this, and this is why I love what you guys do, is because this was a headline. I don't know if everybody can read it or not, but I'll just show you. It's out of the Globe and Mail. When the day the stats came out, it says Toronto housing market cools down in May as exhausted buyers take a break. So if all you read was the headline, you'd have an impression of what's going on in the market. And you said it earlier, Jazz. You know, it's so important to look into the details, and I love what you're doing because you get into the weeds a little bit on this. Otherwise, you read headlines and you make assumptions about what's going on in the marketplace. And that was in the Globe and Mail on Thursday morning when the stats came out.
It's funny because I remember a time about 8-9 years ago, there was an article, a headline in Globe and Mail that spoke about the market just slowing down, and then the same day Toronto Star had an article that said the market is so hot. So, like, I get what happens with our insiders and just the general public.
No, that day was ridiculous. Like, it's actually memorialized forever because we have graphics of it. It must have been 2014
or something like that. Yeah, it was about 7-8 years ago.
It was when the market was like starting to really shoot up. And in the same day, cover stories. One is showing an ice box and the other one's on fire. Yeah. And it's like, you know what? Your credibility, both of you. Shame on both of you. Because if you read the article, both articles were the same. Yeah. They were great articles. Yeah. But to get the consumer's attention, it was completely miscued.
Well, brother, if it bleeds, it leads, right? And so I think what we have to do as the general public, and anything that we're seeing online or on TV or listening to on the radio, even here on Brunch with REC, like, we're no different. We need to sometimes come up with some headlines so to make you guys come on to brunch. It's 30 degrees outside. Like, we better say something in that headline to capture you, to bring you in. But make sure that you're not just a headline reader. Dive into the stats. Yes. And that's what we're going to be doing today. And big shout out to William Clark. I mean, you're someone who's been following us for years, done a lot of business with us, and now we're starting to see everyone come in. I know it's the 30-degree weather that's holding people back, and I don't blame you. But we're going to be here for probably till about 11:30. So we, again, welcome everyone that's coming on. And Mitch Parmesan, I'm not sure if you ever caught the intro of Brunch with REC, but your voice on that intro, I mean, you should probably be charging us because it's such an amazing voice on that intro. Chris, let's jump into the general GTA market stats.
Super. I think, Stephen, you've got a first slide there for us with the month of May summarized for the last 5-6 years, which gives us a picture. And the reason why I love this, and it may be difficult for everybody to read on a small screen, but you can pinch in and take a look. What we do here is we just give you a quick overview of what it looks like to take a big step back and say, okay, you know, let's not get caught in a headline here. Let's take a bigger view. And so it summarizes what the months of May have looked like in the last 5 years in the GTA. These are the Toronto Real Estate Board stats. This is the overall market. And you can see what's happened and where we've come from just in the last 5 years to where we are today. We have number of sales, of course, is the absorption, the amount of transactions that are happening. And I'll just point out a couple of things in a second as we go through. And then we've got active listings. And as Jazz mentioned earlier, we watch the ratio between sales and active listings because that talks about how quickly the market is moving. And the column on the far right, the months of inventory, indicates what's been happening in each May of the last 5-6 years. And then, of course, the average sale price, you can watch how that behaves relative to the months of inventory, because that is going to show you when the demand and supply has tightened up, which causes massive price pressure. And I'll take you back to 2016, when the last time we had 1 month of standing inventory, which you'll see we're back in today with 1 month of standing inventory. And if you were in the market in the GTA in early 16, looking, it's hindsight's 2020, as my father always says, but we could tell things were getting hot, and you guys will remember how crazy it was and the pressure that was going on prices. And that just started it and rolled into 2017, where finally the regulator stepped in and said, okay, we're going to have a 16-point fair housing plan. And that was brought in May of 2017. And you'll see in the numbers where you'll see that things had gotten quite hot in early 17. And then if you follow that, you'll see that we had a bit of a peak there in 2017. And you fast forward 12 months later, prices had actually pulled back. So, people say, oh my gosh, real estate prices have gone up forever. Well, they go up, but they go up and down along the way. There's different factors that drive values. Over time, you can see just in this snapshot how, just looking back, I'm sure we can all agree, I wish we bought more real estate in 2016. But look what's happened, right?
2014, 2013, and last year. There's only been a jump of, 28% since last year anyways.
Yeah. And who would have thought back in May of last year, in the middle of this very, very, very scary pandemic, as the world was shutting down, that buying real estate would have been a continual safe bet. So there you see what happened. The market has continued. We took a quick look back to 10 years ago to put it into context. The average sale price in the Toronto Real Estate Board in May of 2011 was $485,000. $485,000, and we're at $1,080,000 now. So if anybody's wondering if you should buy or sell real estate, buying and holding is definitely seems to be the way to go.
And look, we usually talk about it doubling every single decade. We've obviously we've now seen more than a double in the last decade. I actually want to go back to something that you said, Chris, about showcase, like what happened last year, May of 2020, compared to even this year, May of 2021 now. What do you like? Why do you think values have continued to go up as we're still in a lockdown? Like, what is your answer? Because you're getting the question from 1,300 people every single day. What's your thoughts on it? Like, how did we still continuously see, on average, I think Zemo said 28, it's probably like 21% or something like that, to be exact. What's your thoughts on that? Like, we're in a lockdown, right? And we don't have people coming in. Like, for GTA, we hang our hat on the fact that we're used to getting in a couple of 100,000 people every single year coming into the GTA. That obviously didn't happen this year. I think it was down by like 90%, right? And so what's your
artificially down, but yes.
Yeah, what's your take on that, Chris? Like, why have values continued to go still up?
That's a great question, Jazz, and I think it's important to talk about. There is a number of factors that drive real estate values, of course. And immigration demand, which equals demand, is one of them. What's interesting is the demand was built in, is part of the reason why we feel that the market has continued to be very, very strong. Demand was built in because we've been growing for the last decade in the GTA at enormous numbers, record numbers, really, and ultimately will continue to. So built in, folks that have arrived over the last 4 or 5 years, not everybody buys real estate. Royal LePage actually did a survey 2 years ago that determined about 20% of people arriving into our marketplace buy first, 80% actually rent first, which makes total sense. If you think about it, you're coming to a new place. You want to maybe figure out, what neighborhood do I want to live in?
Settle in.
Right? Where do I want my kids to go to school? What's my lifestyle going to look like? So I'll rent first and then get educated and go and buy. So I think one factor is we've had such tremendous growth here. People are finally making those decisions, spurred on by the fact that interest rates dropped to historic lows. I mean, when in the 1st of April last year, just a year and 1 month ago, as we entered the worst part of our COVID reality, interest rates were hovering around 3% for an average 5-year fixed interest rate. By the 1st of June, so 60 days later, interest rates had dropped in half to 1.5%. So, I mean, that alone, it's almost it's almost like free money. I mean, it's not free, obviously. You have to pay it back, all those sorts of things. But in terms of the cost of borrowing, right, dropped dramatically. And so I think that's a factor. I also, sadly, there have been sectors of the economy that have been absolutely devastated. And it gives me chills, actually, just thinking about it. The family businesses, the industries in hospitality, travel, restaurants, many different businesses in our countries around the world, specifically in our own backyard, have been devastated. And it's frightening to think about. That being said, that is one part of the economy that, sadly, with the reality of this global pandemic, which was a health crisis, initially not a financial crisis. We have to remember, going into this, our economy was bubbling along. Our market in the first quarter of 2020 was setting new price point levels, which we're going to dig into in a couple of minutes here. At that point, so we had a great economy, we had a growing GTA. Interest rates at the time, even at 3%, were really, really solid. And then we went into this terrible situation. But the majority of the economy, with the government's support and the things that they've been able to do to help us navigate this unprecedented time, has resulted in the fact that people felt comfortable that they were going to be able to make their mortgage payments. They once things kind of settled down by June of last year, and we navigated the really, really challenging 60, 70, 80 days between the middle of March and the 1st of June, things started to, okay, we've understood COVID a little more. We've navigated better than we thought. And so people started to say, okay, what is life going to look like? Well, maybe communal living in a condo isn't what we want. We need our own backyard, because riding up and down an elevator right now is dangerous. Everybody wear masks, one person on an elevator at a time. Only your family unit can go into small spaces or be welcome into homes.
Make sure you wipe the vegetable pack, when you bring it into your house.
It's
I mean,
true,
that was all
man.
going
It was
on.
crazy.
Right? It was
Crazy, right?
Sorry. Yeah.
And then all of a sudden, people started saying, okay, well, if that's the case, maybe I should go look for a house with a backyard, or a townhouse, or a semi-detached. And folks that had maybe moved here in the last 5 years said, what, interest rates, because everybody understands interest rates, or should, if they're thinking about real estate, they do. Cost of ownership dropped. That's a major factor in driving real estate market, is the cost of ownership. And that can mean taxes, heat and light. But of course, the big one is your monthly mortgage payment. So it goes from 3% to 1.5%, unheard of. As you know, we've saw 0.99 rates out there as well for variable rates. I mean, it's shocking.
HSBC.
HSBC, right? And they jumped into the market, and away they went. So
Simos and I closed yesterday. Congratulations to you again, Simos. I haven't seen you. We closed on a property yesterday, a 500 square foot condo right in the heart of downtown Toronto, which we bought 3 years ago. We bought this condo for $400,000 3 years ago.
Along with a couple dozen of our clients.
Exactly 11 to be. No, I think this one was 11 to 12. And we got an appraisal report at $600,000. And the interest rate that we closed on was 1.4% for a variable rate. And we're self-employed, so it's generally a little tougher for us self-employed people, right? I mean,
Yes,
still, luckily my credit was better than Simos's, so then I had to, buddy. I had to.
Like,
I haven't seen you for so long.
The truth of the matter is, it was his turn to close.
Yeah, that's what it was. So just so everybody knows, when I was talking about joint ventures, Simos and I till this day do joint ventures, and we kind of alternate on who closes on properties. If you're ever wondering how to put joint ventures together, it might sound complicated, but it's not. Our own VP, Laura Stewart, just did one with her father. Yes, her own father. She did a joint venture. Not very tough to do. Just shoot us an email, info@reccanada.com. As I always say, write everything in the subject line. Make it easy from our boy Tai. Write a paragraph in the subject line if you'd like to. But what you could do is just write JV, and we'll make sure that we'll get in touch with you. But 1.4%.
Yeah, so just before we move past, a big shout out to our accountants, Arnini Stellato LLP,
yes,
for putting up with our nonsense. And actually, it is a little bit more complicated than Jazz is making it out to be.
Yeah.
And there's a big web to be spun by our accountants. God bless you that you're on board and you help us every day structure these deals and get our stuff in line.
Great segue. You must have my script that's written on the table here. That next brunch, we're going to be bringing in Jeff Warren, our real estate accountant as well, and he's going to be speaking about all things. Do I need to do a corporation? And how do
fantastic.
He's awesome. A lot of our insiders are working with him right now as we speak, and he's going to walk through what if you should be doing a corporation or not, how to set up your accounts. I mean, this is huge, right? Like, you don't bring in all your rental income into your regular checking account. Let's go open up a separate account, have all your income and your expenses running through that account. And so we'll definitely, as I mentioned, going to be diving into that with Jeff Warren, not next week, the week after that. So Chris, I also wanted to speak about what you said, that when people were thinking about leaving their condos and going into the suburbs so they could get that extra space inside the home, the extra space outside with a backyard, we saw a little window of opportunity. And I know we can dive into that. Stevie, maybe you can bring up the micro analysis, because I love when Chris goes through this with our whole organization, and he really dives into this, because this is the micro analysis. Now, this is the one. Yes, thanks, Stephen. Where not only are we diving into specific areas, but we're actually going to be speaking about different property types, because condos behave differently than townhomes, which behave differently than semi-detached and detached homes.
Great point.
Like, this is now you're not becoming a headline reader. So REC Insiders, REC Nation, if you're watching this and listening to this live, we appreciate it. Throw in your questions. We will definitely come back through, oh my God, somebody just is asking you, Chris, why does your hair look so good? Different topic, different day, I guess. We'll do a separate brunch on that. As I mentioned, guys, I'm really monitoring these comments. So throw your questions in. We will come back. It doesn't matter how deep in the thread it goes. I'll make sure I get back to the questions. But if you're watching the recording, I also want to give you a shout out as well, because we know thousands of you watch the recording. Right. Chris, let's talk about these micro and
the
properties.
Asset class within the asset class.
The asset class within the asset class. I love what you just said, brother, because as I mentioned, in that 3-month period of September-ish, October of 2020 to December 2020, I was screaming from the rooftops here at our head office at Don Mills that real estate, specifically downtown Toronto condos, has gone on sale. Yeah. And Chris is about to show why that probably is not the case right now as much. Let's bring that up, Stephen. I want Chris to really talk about this.
And this is such an important exercise to go through. And I'd recommend everybody does this when they're looking at real estate in any community that you're looking at, is go back, look at the historical product type, area specific, micro market specific, because this tells the story. And what we'll do is we'll quickly tell the story for condo apartments. So what we've done on this chart, just for examples, because they tell their own story, we've taken by district, which is condo apartment CO1. If you see at the top line there, CO1 is, if you're not familiar with the Toronto Real Estate Board, we divide the region into districts. CO1 is downtown Toronto, west side of Yonge Street, and it is south of Bloor. Just had a blank there, but south of Bloor, west side of Yonge Street. So if you're familiar with Toronto, the density that's our most dense area in the GTA. Then we throw in detached homes in Mississauga, which is west suburbs west of Toronto. We compared detached Whitby, which is eastern suburbs in the GTA, semis in E01, which is the east side of downtown Toronto, where you have old Victorian, beautiful, original architecture, these stunning little houses with no parking, and you got to park on the street in old Toronto. Like, it's a really cool walkability, like it's very, very cool. And then Brampton, which is in the northwest quadrant of the GTA, we have semi-detached in Brampton. Well, so these are all different price points and all different types. So let's dial into CO1, which, Jazz, you said we talked about a lot in the fall of last year, and you can see why. But I'll take you back. So the bottom third of the chart shows the summary of February 2020. So remember, this is right before COVID became a massive reality in our own communities here in the GTA. And you can see the average sale price there was $840,000 for a condo in CO1 in downtown Toronto, the average sale price. And this is resale, just to be clear. 1.1 months of inventory. So and as I said it earlier, the first quarter of 2020, or almost all of the first quarter up to March 15th, when they announced the shutdown, was on fire. Market was busy. We didn't have enough supply. You can see there 1.1 months of inventory, and the condo market was extremely busy. Then what happens? Well, we learn about COVID. COVID arrives on our shores, and all of a sudden our world is changing dramatically. We have to stay home, where it was dangerous to get in contact with people. We're humans. We're wired for human contact. We're wired to be together, to socialize, to live communally. And what happens? We're told we can't do that anymore. So then we jump to October on the next, and you can see what happened. So from February to October, the downtown Toronto condo market just flipped upside down because of this uncertainty. So we jumped, and this is amazing how volatile that market has been. And
Chris, I just want to add something, because not everybody's from the GTA. C1, west of Yonge Street, south of Bloor. We are talking about the financial district, the entertainment district. We are talking about the most density in all of Canada. Harbourfront. So this is Canada's most dense block of real estate, period.
Yeah.
So when we say COVID hit and the first one is affected, clearly it would be C1, because people ran for the hills.
Well, it's like comparing Manhattan. This C1 is Canada's Manhattan.
Yes.
Hands down.
Thank you.
Hands down.
It's perfect. So just so everybody can get that visual,
Great
where all
point.
the skyscrapers are, that's where they are.
Okay.
Yeah. And that's a great point, because that's why it is such a powerful case study to look at what happens when something dramatic happens about lifestyle and change. And I think you mentioned it, Simeon, as well. You said it was purposely paused. It was a purposeful change. So you can see there now in the October stats what happened. We now have 5.5 months of inventory, 1,844 units, 5 times more than there was in February, and the same number of sales, 340 transactions. So what's fascinating is the transaction volume didn't change that much. What changed was the availability of suites. So this is where it helps us understand the dynamic of supply and demand. So demand, actually, if you look at it, didn't change dramatically, but supply increased 5-fold. And a couple of factors there is Airbnb rules changed. We had no students coming back to our incredible universities that are housed in the downtown Toronto area. We had people working
Chris,
from
I
home.
have to jump in. I have to jump in because the Airbnb that was implemented end of 19. So October 19, the rules change. By the time February came, where like it started to like actually affect the market, COVID hits. It freezes air travel, it freezes travel, freezes universities. Yeah. So you have a return of 5,000 condos to the long term. So they went from STM, short term market, to LTM. Or LTR, and so it went from 5,000 units in C1 that were in Airbnb are now forced and mandated by law to return to long-term market. So all these vacancies, which is again an artificial change in the market, you went from an organic 10-year Airbnb curve to overnight, it's now illegal, and if we catch you, you're going to get fined. So all these guys put 5,000 units into the market in C1.
The perfect storm.
Perfect storm.
You couldn't have had a script to slap people around any further.
And there you go. And so that's when, Jazz, you were saying, I know you were telling everybody in the REC Nation that things were on sale in downtown Toronto, and we love, Warren Buffett. I love he's a visionary investor, the best of all time. And as Warren Buffett says, sell when people are buying and buy when people are selling. And if you look at those stats, the sellers were dominating that moment in time because of the uncertainty in the marketplace. Normally in September, you can't get a condo for rent in downtown Toronto because all the kids are coming back to schools.
We see multiple offers.
We see multiple offers on rentals, right? Because there isn't technically there is not enough supply in our marketplace today, technically speaking. There's an unnatural pause in the market right now. Now, mark my words, it's going to get busier in August and September. That downtown core is going to be even tougher, which is going to put more pressure on pricing. But now you can see, if you jump back one more time, Stephen, to that chart, just to wrap up on this point, you can see now in May, the dramatic change from October to May in the CO1 district. Inventory has dropped by 3/4, 75%. Demand has risen. Supply is low now. We've got 1.5 months of standing inventory, and prices have reversed their trend. They basically bottomed out in October, November of last year, and they've ultimately been growing ever since. And so what happened in November last year, if we can all remember, the vaccines were announced. You remember that, guys? It's like, gives me chills thinking about it. I can remember when they said they've got it and they're coming and we're going to be okay. The world changed.
That's right. Confidence instantly boosted.
Exactly. And so when we got back to work after the holidays, late December, we came in January, and not that we ever really stopped, but you know what I mean. and all of a sudden the confidence was there and the market returned, and you're seeing it in the prices. So that micro market is a brilliant picture of supply and demand, how it affects real estate values, and why it is so important to dig into micro markets to understand what's going on with pricing pressure and where things are going. That's your leading indicator of where things are going to be going.
I want everyone to text the word stats to 647-372-0126 to get your copy of what Chris was just sharing as well. And Stephen, I think it's like all the other markets as well, right? We have it. So as well, not only are you going to get what we were just sharing on our screens, but you're going to get a detailed look into the other micro markets, the Oakvilles, the Durhams,
we're actually reaching to Hamilton at this point.
So, and that's in there as well. You have Hamilton, you have everything in that folder. All you got to do is text the word stats to 647-372-0126. As you were showing that micro analysis, and I started to look at exactly what the months of inventory is in C1, for example, comparing it to what it was pre-COVID. I mean, we're right there. I think it was 1.5. We're at 1.5 now. Pre-COVID was at like 1.2. So we're very, very similar. I have a feeling someone's sitting and watching right now and saying, well, I missed my opportunity. I missed my chance to actually make some money. My personal opinion, and I definitely want to hear from both of you guys, is, well, no, that's not true. Because if you looked at the other slide we shared, what happens with values is that they continuously move upwards. I know we sound like a broken record, guys, because I hear it on my socials as well. You're always saying the same thing, Jazz. Well, you don't want me to make stuff up, do you? So, and the reason we say the same thing is because this is what we believe in, that we know that real estate values are going to continue to move upwards. They're going to have the dips, as we just showed on the graph. And as Chris mentioned, why am I telling you this? Because you didn't miss your opportunity. You did not miss your opportunity as long as you stick to the fundamentals being, in our opinion, and again, this is just our opinion, you don't have to agree, and it doesn't make us 100% right, which is invest where you know people are coming, because when they're coming here into our city, they need one thing. They need housing. I loved what you said about the 20% and the 80%, Chris, because you said 20% people buy. That's great. Whew, do I love the 80% that rent as an investor, because they need us. Now, are all 80% renting duplexes and renting condos in downtown Toronto? No, they're renting, they're renting those old, what I call like the teacher pension plan apartment buildings, right? Like the ones that were built back in the 70s, I guess, Chris, those were built. Some people are renting those because there's really no amenities in those, and they're older and the rent is lower. But out of that 80%, a good chunk, like let's just call it 50% out of the 80%, that's a big number still, are wanting more amenities. They want to be closer to transit. They want to be closer to where they work, and they want lifestyle, which generally downtown Toronto offers that. I know you had a point, Simos, that you wanted to touch on in terms of are people, if someone's watching right now, have they missed the opportunity?
Yeah, so there's a few things that I want to go over to. I actually don't know if we have enough time because they're kind of big topics. I will speak to that. Did they miss the opportunity? And the answer is overwhelmingly no. And I'm not talking about Toronto real estate, and I'm not talking about any real estate. I'm talking about, we are human beings with us. It's in our civilization that we're living in right now is an evolving one, meaning there's 7 billion people on this planet. If you think this is going to be the first or the last pandemic, you got it wrong. If you think that there's not going to be something else in a couple of years, it doesn't have to be a pandemic. It can be a ramdemic. It doesn't matter. The ups, the downs, the this, the that, the war, the election, it doesn't matter. Opportunity is every single day. Opportunity in real estate specifically has been there since the beginning of time. It is when it's your turn to live. So right now, we are the ones on this planet. We're so fortunate, 1 in a trillion, to be lucky, to be alive and healthy, to make a conscious decision is how you need to look at this thing. So it's your turn to roll the dice. And are you going to choose to invest in real estate, or to invest in stocks, or to do whatever? Whatever it is you choose, there's always opportunity. So in real estate, if you drop me in Red Deer, Alberta, or Vancouver, or Toronto, doesn't matter which market, they're all different, white to black, different markets. But in each market, when you start at the macro, you get an understanding of what the market is. When you start delving in now, stage by stage, you're going to find where your sweet spot is. Yeah. Just because me and you invest in condos does not mean that Slightum invests in condos. Well, maybe he invests in apartment buildings. Maybe he invests in warehousing. Maybe he invests. Everybody looks at the trends that are happening within a geographical region. Within, like right now, Toronto is the biggest tech boom in North America. More than Silicon Valley, more than New York. If anybody doesn't believe this, go onto the old Google and Google it. Toronto is the center of North America today, right now.
In terms of tech.
In terms of tech, prop tech, fintech, money is flowing into Toronto at a pace never seen before. So if you don't believe that this is, you've missed it, you are simply being ignorant to yourself, meaning that there is a strategy for you. Which one is it? We can figure out together if you want us to, if you want to call in, do what we call a real estate action plan. We hope and pray that we are honored to be a part of your journey. and we can sit down and discuss it. But the question, did I miss the boat? The answer is always no, because there's always a strategy that is right for every single person, whatever that part of the journey is. So the answer is no. Give your head a shake. Start building your team.
Chris,
And
I
I
mean,
think-
go ahead, Chris. Go ahead, please.
I think, Simi, you're right on point there. And I think you guys have always said this because, and I know we align on this as well. And because buy and hold is our strategy. And a lesson to be learned here, to be taken away from this downtown Toronto condo market situation. And we were telling everybody that owned condos all throughout last year, please don't worry about it. We're going to go through a bumpy patch, but we've got to take the long view, because that's what's going to give you the greatest success. And even if you had condos in the marketplace and you thought, oh my goodness, is this the end of the condo market? And there were headlines about that. The end of the Toronto condo boom, the end of the condo market is over, blah, blah, blah. And here we are today. It's already recovering, because think about real estate in a long view. Understand that the market is going to have its moments for different reasons. Study those moments, study the micro markets. And I think the long term is hugely valuable.
I really like the fact that you mentioned the rough patches, because we had clients that we were renting out their condos. I mean, and I see the names of people that are watching today. So a lot of them actually had invested, and we closed on some of these properties in November and December of last year.
In the absolute heart,
like
of the pandemic.
And they closed on condos, Chris, downtown Toronto. And we had to rent out those condos for them. We rented out every single one of them, I think to the tune of about 69 to 72 condos. Okay. 3 different buildings. Okay. All in a
massive shout out to the beautiful Rosanita Rodriguez, the beautiful Katie Sackern, the amazing and handsome Gevik Bonian for putting in that work inside the pandemic, up and down those buildings, while there's huge signs saying this building has like 18 cases of COVID. These kids were going in like surgeons and showing properties.
Because our clients asked us
God
to,
bless
and
them.
so we did it, and we had to do it. But I mention it because, yes, they had to take a little lower rent compared to what the rents were pre-COVID, but the values on those properties from when they bought it and to what it's worth now, it's a difference of, on average, I think we calculated like $175,000 to $225,000. Simos, I think, like when we were doing the math on all that.
Yes.
And so, yes, the rents were slightly lower. And yes, you maybe now had to put in $200 a month out of your pocket. But if you just weather that, that's $2,400 we're talking about at for the 12-month, 1-year period. But your value went up $200,000. Easy math. 200,000, take away your 2,400, you're still in the black. And so just if you look at this,
$198,000.
so as long as you look at this for the long term, I mean, I'm just coming out with a video. I'm going to take everyone back to the first condo that I bought at King and Bathurst. Video shot, everything. We're just finishing the editing. I took everyone back to my first condo that I bought in 2010, $339,000. I lived in there. My firstborn was born. It's a small little 600 square foot condo. It was a 1-bedroom. So I think about 4 to 5 years later, we left Stafford Street, right beside Stanley Park there, backs onto Stanley Park. It's now worth $700,000. I kept it. I've held on to it. In fact, I walked into it, went inside the condo, showed the tent. Like, the tenant was so nice to me. He allowed me to kind of shoot it all. But there was a time where when I refinanced it, I was $250 negative. And everyone around me was like, Jazz, this is the stupidest thing you're doing, that you're paying $250 a month. You're bleeding. I'm like, no, I'm not. This is costing me $3,000 a year, but I refinanced it twice. I used it as an ATM twice to the tune of $175,000 when I refinanced it. So now the bank gave me $175,000 tax free, and it cost me $250 a month. The question is not if you should do it. It's how many times can you do that?
Now you just opened up a can of worms.
Well, that's a refinancing, and we're going to do a full brunch. Go.
But you know why? Because it is only because of the power of real estate, because of the ability for you to refinance that specific condo. And this brings me chills. this specific time of our lives.
Well, you knocked out on
That
that.
was-
You knocked out on the couch of that condo, so you know that condo
more than
brother.
once.
Yeah, more than once.
But that condo, that property specifically, because I did the exact same on a property in Oakville at the exact same time, is the only reason we stand here today, is because the money that we refinanced, that real estate is what financed the REC operation 12 years ago. That to anybody in REC Nation. So when we talk about the power of real estate inside this room, it goes real deep, and like literally to the actual fabric of of ourselves, our families, and our organization. Because if it wasn't for that, these two young cats, we were what, 28? I was 29, you were 27.
Well, I'm 39 now, so
Whatever.
10 years ago, 29. Yeah, exactly, right? Yeah, bang on.
Yeah, bang on. We would not be here selling real estate, doing what we do. So God bless real estate. God bless
Well, I mean,
real
Chris, how many times have you experienced that, right? In your
Oof.
6 decades
Come on.
and in owning real estate, and I'm sure you've sold a couple of properties and kicked yourself because you probably shouldn't have. I mean, we've done that too. There's another video that I showed my family selling their properties in Rexdale. I mean, yes, I know that the values don't appreciate as quickly compared to other areas, but how many times have you experienced that personally?
It's one of the things that it's a lesson. A real estate lesson is to keep everything, and you kick yourself. I mean, there are strategic reasons to make trades, absolutely, but there's very few reasons to sell if at all possible. And you look back in the GTA, when you're in a market like the GTA, where you've got decades of growth that have happened and decades of growth to come, really, you've got to look at the supply and demand reality that we're going to face. Simeon, you mentioned about the growth in the technology sector in the GTA is unbelievable right now. You look at about the immigration strategy our country has, which has been the backbone of the incredible growth and exciting dynamic, place that we all call home. It's when you're in a market like that, as long as you believe that growth will continue, which I don't know why we wouldn't, but let's say, there's two sides to that argument, but they're really, as long as that's going to happen, hanging on to real estate is going to be a good thing for everybody, and taking the long view and take that. And if you do that, then when you run into these ups and downs, because we've gone through them, we went through the 90s. If you want to talk about a down, oof, that's a whole other series you can do on
Give
that.
us a 2-minute version of it, because I've never lived it. I wasn't here for it, and I was a kid. I'd love to hear just a 3-minute summary of what that was like for a real estate family.
I love that question. Yeah, what actually happened in that early 90 period, Chris?
I don't know if I can do it justice. I think I got 2 minutes, unless you guys want to go over your time. I'm
100%. Yeah. Oh, yeah.
I can
Sure, we're
stay
going
on. You're
over
okay?
Hey,
Oh, yeah.
Why don't you reset the room?
Yeah,
because this is where real estate convo happens.
Awesome. This is where real estate. It's Brunch with REC that happens every other Saturday live here on Facebook. We start at 10:30 a.m. Eastern. It's the place where real estate conversations happen with your boys Jazz and Simeon, co-founders of REC Canada, a full-service real estate company that has 46 realtors covering the Greater Toronto area and 11 support staff. None of this could be put together without that 11 support staff for sure. And we're joined by broker owner of Royal LePage signature organization of over 1,500, including his support staff. And we're talking all things real estate. We like to go off on tangents. Our insiders
And every time
know that.
and every time we promise we'll be done by 11:30, we break that.
100%, 100%. Our wives are used to it, and so they know that we're not coming home on time. It never really does happen, anyways. So, Chris, the question was posed to you in the early 90s, mid 90s. What happened in real estate? Because we hear about a lot about that. We actually dive into the stats, but we never lived it. Myself and Simos never lived it, and you did. And as a broker, but also as an investor, as a homeowner, what was going on? And then please make sure that you speak about how we got out of that.
Sure. Yeah, no, it was a wild ride for sure. And looking back, you just there's a lot of lessons that have informed how we've made decisions going forward in our investing and real estate business. But what happened was leading up to the 90s, there was an incredible explosion in real estate values. There was a ton of lending freedom that happened in the late 80s. The explosion of real estate in the GTA between 1985 and 1990, late 89 really, was massive. I mean, 40% a year, 30% a year for 2 or 3 years in a row. So basically doubled in a couple of years, which is unheard of. Like you said earlier in the show, Jazz, we've been doubling every 10 years. Imagine doubling every 2 years. I mean, it just boom, boom, boom. And when that happens, and then there was a whole bunch of banking regulation changes, and the market all of a sudden stopped. And then we went into a complete free fall to reset the marketplace. And back then there was different banking rules, there was different economic policy, and less of an understanding of how inflation and markets behave. And so what happened was we had to reset. There were a bunch of other factors in the GTA that caused the real estate market to extend its decline over a number of years. So it took about 7 years for the market to fully kind of flush out.
And who was the big loser when this happened? So did people buy at 500 and the market tanked to 100? What was the actual effect? Like, what happened?
Yeah, so market values dropped about 40% on average at that from its peak to its trough. But other people, because there's whenever the market goes crazy on those last few months of craziness, whenever they happen, you'll hear stories of somebody paid what for that property. Well, that you'll have a few of those folks who unfortunately felt even more pain. And ultimately, if you didn't have to sell, even if you bought on the last day of the peak of the market in spring of 1989, as long as you didn't sell and you still owned it, today in particular, if you still owned it, because housing values back then, I think peaked, if I remember correctly, at about 350 or 370,000, if I'm not mistaken. And I'm sorry, I don't have the exact number, but let's say roughly in that range. And today they're 1,080,000. So I know it's a long time ago. People are like, gosh, I mean, that was 30 years ago. Let's hope it had gone up over that time. But if you held on to your real estate, you never really lost. And so we didn't sell anything, even though it was painful, and it was very, very difficult to get through those times. We scaled down our expenses. We cut everything as much as low as we possibly could, so that we could maintain our way through. And our grandfather and father were very conservative, so they were prepared for a rainy day. That's what they've always told us. You've got to be prepared for a rainy day, and if you are, you're going to find your way through. It's never going to be pleasant, but you're going to find your way through. And that's what happened.
Hurt,
and then,
but you won't die.
Yes, yeah, it won't be.
That's what it's all about. Is
correct.
Getting through a storm. And
you'll learn. And so we learned, you always learn more from your mistakes or your challenges than you do from, when the market's kind of doing its thing and going up and everybody thinks I figured out real estate because I made 20% last year. Okay, let's pause for a minute and just acknowledge the fact that none of us thought real estate was going up 20% last year, right? That just happened. So that wasn't a strategy that was put into place last year. It just happened. So we learned, though, from those challenging times. So what happened? Finally, it bottomed out. The economy started to grow. The world got back on its feet. The GTA started to grow. Population started to grow. People started to move around the world a little bit more. And development started to return. And home values got to a point, interest rates got to a point where people regained their confidence. The economy started to chug along. The regulatory environment changed, and we slowly started to build our way out of the depths of the 90s. And then our population engine started to really continue. And a number of things have happened since then. Interest rates changed dramatically in the 2000s. We as a as a nation survived the global financial crisis better than our neighbors in the U.S. And due to our bank structure here, we learned a lot from the early 90s. So what happened was back, I don't know if everybody's aware of this, but before 1990, you could actually build a condo building and get financing without pre-sales.
Didn't know that. I didn't know that. So that's where the lending requirements of banks to developers, I guess that it came out of that buildings need to be sold. 80% of the building needs to be sold before they can get construction
That's right.
financing. So for everybody who drives down the Gardner or the DVP and sees all these cranes and they ask the question, oh my God, who's going to buy all these condos? That's never the right question to ask, because it's who already bought these condos, because that crane could not go up. So it came out of the fact what we learned from the 90s, then, Chris, is what you're saying.
Exactly, because up until 89, real estate had been on a run since the beginning of time. I mean, there were short moments in time where, during the oil crisis, interest rates went to 21%, but that was a 6-month or 8-month or 24-month period. And then, and it kind of moved along, and real estate didn't have its ups and downs, but there was a tremendous amount of growth in the late 80s, right? I don't know, it's not the roaring 20s, but it was can't remember the analogy for the 80s, but it was a rocking time. And so all of a sudden these buildings were being built and the banks would loan it to developers. They weren't being carefree about it. They had pro formas and they had projections and all the things that went on with proper financial analysis. But what they didn't do is they hadn't thought about, well, what happens if people stop buying and we're a third of the way through construction?
So I think, guys, what it is what the bank did is, instead of, sorry,
I just want to get closer to the mic.
Sorry, apologies. What actually happened is the bank transferred the onus and the risk. So if you give it to the developer because the developer believes that's one entity, but it's still one way or another, when you build for the future, it's speculation. You're speculating based on your education, based on your plan, based on your experience. You're making a plan to build for the future. It's still a speculation. Speculation, people have this, it's more like a bad word almost, but it's not. It's just a word that defines the future. You're speculating that you will be right. You're speculating that you will be wrong. It's speculation. So the bank says, instead of me having to take Jazz's opinion or take his opinion for granted, why don't I spread it across the 200 people in the building that will be living there? So now you've turned one major speculator into 200 micro speculators. So the risk profile goes down by 200 exponentially.
And you could do that personally as an investor as well, right? Don't use 20% in your pro forma / projections. Why not go ultra conservative? And knowing that the GTA is year over year increases, call it 7.5% for the last 40 years, it's probably, and taking out last year, let's take out the outlier anomaly of 2020 / 2021.
And going up 20%.
And going up 20%. Let's take that out. We're still over the last 40 years at 7.5% year over year increase. Why not be ultra conservative and use 5%? You know what? Use even 3% year over year. If your numbers work at 3%, compounding, then make a decision. And I think, yes, definitely, Simos, you're right when you talk about the fact that it's speculating either way, and it does have a negative connotation. But
they were smart about it. But the banks were smart about it, to what Chris was saying. So I'm not going to lend to you because you said so, Jazz, but I am going to lend to you because now you've proven to me that 150 of your tribe are willing to put in their 2 cents to make up that down payment.
And when you say 2 cents, it's actually 10% of the purchase price. Exactly. Like that, it needs to be. That's why anybody who's ever done a new build condo with us, and there's hundreds upon hundreds of you, that the builder always wants to get to 10% of deposits within 90 days to call it 6 months, 180 days, because that's when they qualify for their construction financing. They can start to break ground. You also mentioned, Chris, like just what the banking industry learned. I mean, I think because of what happened in the 90s, late 80s, early 90s, and then in 2001, I believe the Canadian banks got it right in 08, 09. And the rest of the world, right? The rest of the world was looking at our banking industry, which, you know, for us, we kind of make fun of at times. Like, you guys are so conservative. Like, come on, like, we have good credit, we make good income. Like, don't put us through the ringer to get a mortgage. But they do.
Who got us through that? Was it Jim Carney, Chris?
And back in 08, 09?
Yeah, I think was it Carney in 08, 09? I think so.
I think so too.
Yeah.
All right. And the rest of
one of the best leaders that you could have possibly had at the helm.
the rest of the world was looking at us and saying, hey, how did you guys do this?
Yeah.
Well, we don't give everybody who can walk, talk, and chew gum at the same time a mortgage. We put people through ringers here, and I actually think that protected us.
Yeah, and if you actually look at the U.S. chart when they went through their early 2000s housing explosion based on financial derivatives, mortgage-backed securities, free lending and loaning, it actually almost mirrors what our late 80s explosion looked like. Some different reasons, but the concept of easy access to money and lending is really the underlying fundamental to that, would cause that with the kind of some loose lending guidelines, we'll call it, to say the least, created that environment. And so the US market, if you take the two charts and overlay them, they actually have the same kind of experience. And so the US peaked in 07, I think it was officially. Lehman Brothers and Bear Stearns collapsed in 08. And it took, 4 or 5 years for things to kind of work their way out.
So just to summarize it, you're saying that not the exact, but it was a very similar situation that led to the subprime crisis, that loose lending, the loosey-goosey, funds for all. That was similar to the mid 80s to 90s. That was the early 2000s that led to the collapse in 08.
Correct.
They have a similar curve on the graph.
Similar looking curve. So, and again,
is there any similarity to today's pump up?
Great question. So I don't think I think it's a different version today, because looking back then, and all the banks, all the global banks learned from that financial crisis as well. So the lending, you think about, and this is what, I'm so impressed with our country and how the regulators have put in the qualifying, that 2%, mortgage qualifying rate approval buffer. Brilliant, right? Because if rates go up, well, at least you qualified for a higher rate ahead of time. And that's been in since 2018. So now you think about the next cycle of renewals, even if rates were up, there'd be that buffer. So that's why I think today is different, in the sense that there's different dynamics. Now, there is very, very inexpensive financing available. We just talked about it a few minutes ago on the mortgage that you guys just secured at 1.4%. I mean, it's hard to even really, if you again take the macro look, you take a look back at history, nowhere that I've seen in history will you find 1.4%. Maybe there was in 100 years ago or 80 years ago. I don't know. I don't have that data, but I can tell you, in modern history, 1.4% is free money. So there is a factor there that is driving that. And that's what we talk about as well. If and when rates do rise, you just have to be prepared for it. And there may be a slight adjustment in the market at that point in time. It really depends on how fast those rates rise. And if they rise slowly over time, buyers and sellers adjust to that, rate experience. The reason why rates rise, it's not a bad thing. We have to remember this. Rates rise because the economy is doing better.
Yes.
That's a good news story. So seeing rates rise, oh gosh, rates are going up. Oh no. Well, yeah, of course, as a borrower, sure, you don't want to have to pay more if you don't have to. But arguably, the reason why they're rising is because the economy is doing better. So that means incomes are rising. That means job security is stronger. That means growth is happening. People are building things, inventing more stuff, doing cool, dynamic things that are growing the economy. So as long as those rates don't rise faster than, or a sudden movement, which is really what happened back in the late 80s for us, that's going to be a natural occurrence. Don't panic about it. The market will just kind of roll along. So it's pretty cool.
Yeah, I was going to mention what you spoke about was the 2% increase in terms of qualifying with the new stress tests that just now was not only announced, but now it's came into effect for 3-4 days ago. I've always said I love that they put this into place because it's also going to protect the younger generation from buying bigger homes than they should, and then they actually need, because they were trying to just compete or compare or what's the word that I'm looking for? Just, they want to, I guess, compete against their cousins, right?
They
keep up with the Joneses, keep up with the Sings in Brampton, like that kind of stuff, right? And so I think it's actually a fantastic metric that they put into place. Why don't we quickly speak about the article that you were talking about from a commercial perspective, and then we can get everyone out of here before 12 o'clock so that everyone can enjoy the weather. Again, if you wanted to get the stats and you just joined us, you wanted to get the detailed stats, the May stats, quickly text stats, the word stats, STATS, to 647-372-0126. And I see it in the comments, as well as our boy Tai is making sure that he's monitoring that. So what did you read about commercial real estate?
So for commercial real estate, they were specifically speaking to New York. As the case, it was an article in The Economist, the brand new it's a weekly magazine. The Economist comes out weekly. It came out last night. I downloaded it, was reading through it, and it's speaking to the delusion of major landlords in urban centers that everything is going to go back to normal and everything is going to be okay and there's going to be no difference. And what The Economist is calling on is the ignorance of it all, because nobody knows that. They're saying that there's Moody's, so the rating companies, there's 2-3 major ones, but Moody's says unless all people are at least commuting back into the downtowns. So think of New York, think of Toronto. If anybody thinks that everybody who works downtown lives downtown, you'd be crazy. Now, 75% of them live in the suburbs, meaning the Mississauga, the Etobicoke, the Bramptons, the Richmond Hills, and everybody rips downtown every morning and comes back out in the afternoon. So what Moody's is saying, as far as a credit rating, to imagine who the landlords are, guys. So every single pension fund, every REIT you've ever heard of, RioCan, Oxford, Cadillac Fairview, etc. So all these major landowners and landlords, people, what they're saying is no, everything's going to be fine because TD is still paying the rent. Well, TD, unless COVID, right now COVID is resolving itself. But to think that there's going to be no fallout and no impact as a result of an 18-month stall in the marketplace, that an 18 months is long enough to change consumer behavior. Don't kid yourselves. It's not like one and done and everything is the same. Yes, there will be employers. So they're comparing in New York now. They're comparing Goldman Sachs. Goldman Sachs is saying everybody's coming back to work. That's their stats.
So they've said this already?
Goldman Sachs is saying, everybody, listen to me now, that in the next under this protocol, everybody's coming back to work.
Okay.
And then it's comparing Goldman Sachs to, I think it was Bank of America, who is saying, everybody stay at home. But now you're talking about the dichotomy. You're talking about two major stances by two absolute giants looking at the world differently. So if there is going to be camp 1 and camp 2, and now we're going to take corporate America, or corporate North America for that matter, down that train of thought. So if there's going to be a choice where TD says, you know what, everybody work from home, CIBC says coming back to the office, Royal Bank says hybrid it, do both. You don't think there's going to be fallout if there's 15% less traffic in those buildings in the path? It's going to affect retail behavior, retail shopping. It's going to affect transportation. It's going to affect TTC revenues and GO Train revenues. It's going to affect that whole, every time you drop a stone in the water, that
ripple effect.
The ripple effect. So it was a very interesting article. I'm happy to share it. I can PDF it
100%.
and put it available.
Yep.
It was a very interesting article. I think what I got out of it, so if you ask me what did you get out of this article, is the fact that nobody has the goddamn answer for anything yet. Do I think we're going to be okay? Yes, I do. Do I think the market is going to return? Yes, I do. But is there going to be cause and consequence? The cause was here. The consequence is still yet to be seen. And I think as investors, as citizens, as smart, educated people, we need to keep our eyes peeled, our ears focused, and listen and follow the people who are at the forefront of it all.
Well, to me as an investor, I mean, that just screams opportunity, right? I mean, something is, and sorry, I mean, call me a capitalist in that sense, but I mean,
you are a capitalist in that sense,
right? Like, I mean, it just screams opportunity. But Chris, what's your take on it, brother?
You know, I think you're right on point, Simeon. I think we have to acknowledge that it's going to be a fluid situation for some time. You know, September is a big moment in time, I believe, that we'll keep our eye on because, you know, all things continuing to go in the right direction. In our part of the world, kids will be going back to school. Employers will be making the decision about whether you can work sometime at home, sometime in the office, or as Goldman Sachs has said, everybody's going to work. They have to go through that fluid situation. You know, as a business operator, I'm the first to say it's been a challenge having people work effectively, having an organization of people, individuals work effectively at home. I get it, but having an organization that works together, some people at home, we're an essential service, so we have some people can be in the office. We have all the protocols in place and all the proper social distancing, physical distancing, and everything. So part of our team is here, part of our team's at home. It's very challenging to run a business with people sitting at their dining room table, at their desk at home, some here, some there, some this day, some that day. So
it's tough to have a cohesive direction when everybody's fragmented.
Right? I'm on the side of the argument that people will likely over time return to work. Some roles won't, maybe, but I feel the majority will. So that's kind of where my head's at. I was on a webinar on Wednesday that was being broadcasted out of New York, and the gentleman had flown into his New York office from somewhere else in the US and had to go through not one, not two, not three, but 4 hotels to find a room because the first 3 were full. You couldn't get a room. So luckily he got one in his 4th choice, he said, of hotel.
Well, sorry, Chris, why was that? Is it tourists now are back? Is everyone back? Like
the city, Manhattan is back. He had in-person business meetings booked with his major clients in the city. There's protocols in place in going into office buildings, but they're going out for dinner. Restaurants are full in New York. He couldn't get a reservation at the first or second choice of restaurants he wanted to go to on Thursday night Tuesday night in New York. So in the city, in Manhattan. So, you know, there is going to be, I agree with the economists suggesting that you cannot make a carte blanche statement. Oh yeah, everything's going to go back to normal. I agree with that. But I also believe that as humans, we are, we like to be together. We're interactive people. This format that we're doing today is brilliant because we can communicate and you guys can provide incredible information and education to people anywhere in the world. So I think it's brilliant and has its place and will continue to be used even more and more and more effectively. However, from a true operational standpoint, I'm a big believer that people are going to get back to work. Our roads are going to get busier. Travel will return. But it's going to take time. We're not September 1st. It's not back to normal. It's an evolution over the next, maybe it's 2 years, maybe it's 3 years. I don't know, but it's I'm a big believer in folks needing to be connected, feeling that connection, enjoying the experiences that life brings you from being in a communal space and events and patios. And I mean, it's, I think as soon as, and I've looked at, if you've been up and down the streets of Toronto recently, all the restaurateurs, and I, again, my heart just aches for them, navigating through this. They're out there, they're setting up their patios just in anticipation of some good news coming in the next 10 days or so here in the GTA. And that, but you think about that entrepreneurial spirit. You think that here we are, 15 months of grinding it out, not knowing, open, close, close, open. You can do this, you can't do that. You can only serve 4 people. No, it's 2. Oh no, it's only takeout. I mean, I can't even, I mean, these entrepreneurs, they need, like, to come through this and to see them out there, and they're wiping the tables and planting the flowers and creating experiences for all of us to come back to when we have that ability. Like, it shows you the resilience of society. It shows you what the dynamic growth that a city can and will have. And that translates to that pebble in the water, as you just, a great analogy, and the ripple effect it creates. It gives me that, I mean, it puts that smile on my face. It gives me that sense of confidence that, in the human race, in our ability to solve problems and navigate challenges and take the long view of things, and know that, it's just going to be an amazing place. And that trickles down all the way down to us in real estate and that asset class, that thing that we all need. Everybody needs a roof over their head. Everybody. And how powerful it is, and to be in a market that we're in with all this great opportunity. Like, I'm a big believer in growth. I'm a big believer in returning to a lifestyle that we all used to enjoy. And maybe now I also believe that we will take less for granted. And I think that's something that will be very, very, one lesson that will, I hope, will stay with us forever coming out of this, is to appreciate
100%.
those moments a little bit more, which I know that I will for sure.
And I will for sure. And I know we've lived moments in the last 15 months that we know for sure we're never going to forget, from both from worried about the future, and of course appreciating and gratefulness for what we have, and the health that we enjoyed, and for the people that we didn't lose during a tough time, and all the things that, and all the feelings that we felt through the time. In closing, Jazzy, I want to make a couple very important mentions. As our audience grows diverse, and we're seeing people from coast to coast, June is both Indigenous History Month in Canada, as well as a celebration for the pride of the LGBTQ plus community. And once again, both in both those demographics, there's been massive news and challenges coming out in the last week or two, with the residential school system discoveries, and I don't even know if they want to call them discoveries, because many people already knew about them, and they were kind of just stuffed down a hole and never mentioned. So a huge acknowledgement from the REC to every man, woman of the Indigenous community here in Canada. We appreciate you. We thank you for having us in this country, and on behalf of everybody who wronged you, we apologize too. So just know that you have people from all over the world that have also suffered, and they're here, part of your story and your fabric today. I am definitely a grandson of a refugee, and everybody, or most of the people who landed here, have a story of unfortunate circumstances, and that's how they got here to begin with. But I just wanted to acknowledge that, and to the entire LGBTQ plus community, I do want to remind you that just because you don't have a parade this year, there's a lot of people vouching for you, cheering for you, and be proud and live your life the way you want to. And hopefully the streets are going to reopen, and all of us can celebrate everybody's uniqueness soon enough. So that's what I wanted to just mention from that perspective.
Well, I think once things open back up again, there'll be parades.
Yes.
Even in minus 30-degree weather. We don't need the 30 plus degree weather. A couple of things that you mentioned, Chris. I am going to make a carte blanche statement to our staff. You're all coming back. Period. And so including you, Tai. I love you, but I can't wait to see you, Shem Sharif.
We haven't seen Shem in 15 months.
I haven't seen Shem in 15 months. If anyone's wondering who Shem is, she's our client service manager, been with us
only
for
our backbone.
16 years. So you're all coming back. Period. Done. And to Chris, to you, I cannot wait. And I know I'm speaking, I can speak for Simos as well, till we can sit out on a patio here at Don Mills and have a beer and record that conversation. And we will do a live brunch with REC with all of our audience, and we'll be able to broadcast it, to your point. Now, everything, in my opinion, what COVID did is fast forward everything within a 12-month period that was going to maybe take 5 years.
How nice would it
for
be
it
if we
to
did
happen.
the whole square?
Well, yeah, we'll rent out the whole square here in Don Mills. We'll have a beer, a couple of beers. We'll do this very, very soon live, and then we'll broadcast it to the world. Chris, thank you so much for your time. We said an hour. We went an hour and a half. You know how Simos and Jazz do. We can't, we like the sound of our own voices. We know that. And so just thank you so much for everything that you do, but also specifically for coming on today and dropping so much fire content for our insiders.
Yeah, my pleasure. Thank you so much. You guys are brilliant at what you're doing. I love what you're doing. You take care of sharing so much great information with people. It's an honor to be invited, and I really enjoyed the conversation, as I always do with you guys. I mean, I look back to where you've come from in the last 16 years and what you've done, and I say to everybody, it's just the beginning. You are taking this to a new level. And the results that you're helping people achieve in their lives with the exciting opportunity that real estate brings is just amazing. So great work, guys.
Thank you, awesome. Chris. Thank you Chris. To every single REC insider. Jazzy, close us out. God bless you. From me, lots of love as always. Appreciate yourself. Thank yourself. Take care of yourself and love everyone around you. Jazzy?
I didn't get an opportunity to take a look at the weather right across the nation today, but I have a feeling it's going to be something similar to what we're experiencing here in Toronto. First, at 7 o'clock in the morning, it was 26 degrees. I think it's probably north of 30 degrees right now. Wherever you are, please enjoy the weekend. Be safe. Feel free to reach out to us at any time for all things real estate. We're not perfect, but we will definitely try to bring as much value as we possibly can. And it's really easy, guys. It's info@reccanada.com. Write whatever you need in the email, and our boy Tyler Ty Walburn and the rest of our support staff. Thank you once again, Mr. Stephen Rochester, that controls the ones and twos and makes sure that this gets out to the world. And to everyone else on our team, thank you. And for you, as REC Nation, thank you for giving us your time today. Take care, guys.